right, so this is a continuation of the Wyckoff course that I'm doing, and don't mind all this red lines and stuff. In fact, what I recommend is, you know, as you're reading, then mark up the chart, because you want a chart that's marked up and reflects the course or whatever study. It's like a picture says 1,000 words. Literally, that is the case over here. So we're going to look at the 20th, which is right about here, and from that go forward. All right, and then cover the downtrend again. So next day, June 20, removes all doubt as to the immediate tendency of the average for the market. Before I go further, look at the immediate tendency, not the tendency of the market or tendency of the average, immediate tendency, which means it can change at any time. And right now it's just talking about the current tendency, and that's usually the case where you see markets, you know, they have an immediate tendency or a tendency right now, and it's all it does, it tests a resistance point, as the case is over here, where you have a resistance point up here. All it does is test it or upthrust it. So this is the thing to remember. There's even in trend, you have counter trend, and that counter trend, many times, if you see a pullback on a higher time frame, it looks like a trend on a lower time frame, but all it is really a counter trend to test some area, either a breakdown area or a resistance support area, breakout area. This is what happens. This all the time happens, and you can take advantage of that. Next day, you know, median tendency of the average for the market opened up to 1.5 above the previous night's whatever, makes a rapid advance nearly 131, putting the average into new high ground above the previous trading zone. All it's saying is it took out the area, it took out the zone, it took out the level, it took out all of that, and on greatly increased volume. So basically broke out. Right. Before I go any further, let's go over here. The volume is obviously large for this 2-hour session and hence should be doubled. He does all this doubling, all right? So that's how he deals with like low volume days, because he understands in Wyckoff what he used to do is on I think it was Saturday when the market was open back then, he used to double the volume. I don't know why, but it's probably because to make it a good relative comparison, you would have to double it. So it's like day volume versus night volume. You cannot compare the two. What you could do is multiply the night volume by a certain factor, and that would kind of make it look like day volume, and then you could do a relative comparison and get some type of judgment. But besides that, night volume is always less. Just like this example, weekend volume will always be less than weekday volume. So one of the things he used to do is double up, double the volume, because he believed that that was a good factor to get volume that's comparative and can be judged against weekday volume. So anyway. And also, like for day trading, you will see beginning of the day and end of the day high volume, but in the middle of the day it's really difficult because it looks like a U, like beginning of the day to the end of the day high volume, and then it's like a U in the middle. So market opens up 1.5, etc., etc. The gain in the average over the previous day high is more than 7 points and close at the top. If we want to be watching the tape during the day or refer to our wave chart at the end of the day, we observe this sudden change and we either buy during the session or wait until the price breaks through its former high and buy around the close of the day or the opening of the following session. So how is he buying? If you're looking during the day, you buy during the day, intraday. What else can you do? You could buy it at the end of the day or the next day, right? And he also says, look at the wave chart. Again, he combines these different types of charts, the wave chart with the figure chart and the bar chart. And then he uses a Wyckoff wave as well as an index. The Wyckoff wave, very important because he mentions that it has a tendency to be more sensitive than the market. So there's a time when I thought, like, you don't really need a Wyckoff wave because you just look at the SPY or the ES, but clearly he made that statement that it is more sensitive, and that's why he used it. Otherwise, he would just use this chart. There's no reason to use a Wyckoff wave. He has a chart right here. So anyway, we are not justified in reestablishing investment positions. However, for as explained in paragraph 1, we do not have the basis for a lasting advance. There's no base for a lasting advance. On June 22nd, there's a higher open, a higher gain. The price is gaining in proportion with a rise in volume. A reaction on the 23rd shows that most of the gain was lost. So on the 23rd, the gain, maybe this is the 23rd, I can't really tell. Well, anyway, most of the gain was lost, of the previous day was lost, so that must be the reversal right here. But the bullish indication therein is the shrinkage of volume to 2.6 million. 2.6 million shares, nearly one half the activity of the day before. My bad, it's this bar right here. Right here. So he's saying this is the bullish, this is bullish bar. And this is the breakout, and this is the pullback, and it's almost half. All right. But the bullish indication therein is in a shrinkage of volume in 2.6 million, nearly one half. So the idea here is making sure you pay attention to a couple of things that he always says over and over. He says indication, and then he says confirmation. So really, when you go through the study, focus on these things. When he talks about indication, confirmation, those are key hints on how Wyckoff logic is applied. All right. The shrinkage of volume is the indication, one half the activity of the day before. He considers it activity as well. This is our warning to sit tight. The 24th recovers the loss, and the average advances 8 points for the day and 3.5 points above the June 22nd high, or to 141, and the volume is the highest thus far. You're talking about this bar with heavy volume. We begin to grow wary of the bull side because that volume in comparison with the trading of previous weeks indicates selling by large interests. Meaning there's something wrong. Why? Because it is a buying climax. Why? Because it's the biggest volume on the chart, on the whole chart so far. In 3 months, that's the biggest volume. When you see the volume is that high on a new high, can it be a climax? You bet. So what we want to do is mark it as CMX. All right. So there's your climax. Now let's move forward. Where the hell am I? I lost my position. We move our stops up within a point or so and wait developments. Remember, even if there's a climax, the way climax are described is they do two things. One is they can terminate, or they can indicate a termination is coming, meaning we're close to it, almost there. All right. So he's saying that this is a climax, this bar right here with heavy volume. We move our stops. The 25th makes a further gain of 2 points in the average. Then the price slumps about 6 points, closing a point from the low. So right here, this bar, how do you interpret when you have a climax and then the bar like this? That is just a point from the low on a volume of 4.3 million. This right here, when you have a climax and then you have a reversal on high volume, meaning both those bars are, there's a green bar, a lot of volume, and a red bar, a lot of volume. The way I kind of interpret it is professional selling is meeting formal buying. This is what happens. And similarly, he says large supply is overcoming an excited public demand coming in as usual. So how do I want to interpret this bar? This bar to me, using same logic that he did before, is your change of behavior. Is your bearish change of behavior. Forget the J, is a juicy change of behavior. It's a change of behavior. Why? Because it's the biggest volume you see on a red bar. You know, I bet it's more than like 30, 40 bars. The 20, or at least until this crack right here, this climax low. So we move our stops within a point or so of the 23rd, and what did you say? Large supply. That large supply is your change of behavior in this counter trend back up to that resistance area, that upthrusts the resistance area. This is distinctly bearish. And he's also pointing out, notice the shortening of the upthrusts. That is the tendency of the high points to arch over. So with the shortening of the thrusts, we know that this is a comparison between highs and highs or lows and lows. This is how Wyckoff uses them. On wave charts, it's comparing the wave high to prior wave high or low to other low, wave low to wave low. But on this, it's high to high, and he's saying that this is distinctively bearish because of the heavy volume, but also to note that the shortening of the thrust, that is the tendency of the high points to arc over. So what you'll see is, most of the time when there's shortening of the thrust, what you see is like an arc. All right, so that arc itself is bearish, and this is something really kind of important to know because on pullbacks, right, when you have a rally or a pullback like towards the turning point, a lot of times, especially during the pullback, there's like markets get dull. They go from a lot of good thrust to eventually shortening the thrust. That shortening of the thrust is that fatigue factor that's coming in, and markets are unable to break through, or people are not going to keep on buying and buying. They eventually exhaust. They can exhaust by a climax, but they can also exhaust because they just can't keep buying at the same degree of FOMO, basically. Anyway, this is distinctly bearish. We therefore close our long positions. Why is he closing the long positions? Because of heavy volume selling and the arcing over of the pullback or the rally over here, whatever it is. This is the rally over here, and he's noticing a shortening of the thrust. You can see from this bar to this bar, a lot of thrust, less thrust, less thrust. Very important to measure. June 26 shows a range of about 5 points, a little narrower. Although the close is near the top, the volume has fallen off to about 3.1 million shares, and the upthrusts are shortening. Upthrust, he means this is not a classical upthrust or whatever you're learning in that you have a resistance and then you have a failed breakout, and that failed breakout is your upthrust. That's not what he's talking about. He's just talking about when he says upthrust here, it's just thrust on the up bars, meaning high to high comparison is shortening. This bar's high versus the prior high is shortening than the other bars. So you see this bar here, high to high is less than this bar here is high compared to this bar. See, like there's more movement, more distance, and now it's shortening. In net, these indications are bearish. It's also important to see how he weighs things. This is why it's not mechanical, because many times you will not get a clean signal. You will not get markets, many times, most of the time, they will give you a set of bearish factors and a set of bullish factors, and they require you to weigh. They require you to weigh the bullish factors against the bearish factors and make a decision. This is why one of the reasons indicators don't work, because one indicator looks at bullish factors and will give you a buy signal. Someone else's indicator will look at the bearish factors and give you a sell signal. So, because they cannot compare all the bullish and all the bearish and weigh them, this is the problem. It's logic, and when you're writing code, it's if this, then that, bullish. If this, then that, bearish. So the way you write will give you a bullish factor, a bullish signal based on bullish factor. Someone else, bearish factors, if then statements will give you bearish signal. And this is always the case with breakouts. Someone's signal will say buy the breakout. Why? Because it cleared a level. Someone else will say, oh, it's overbought, sell. That's what happens. So this is why you need to be able to judge the bullish factors and the bearish factors, and that is not easy, especially if there's desire or fear baked in. It always messes with the judgment, always. On the 27th, the average bulges over a point, narrows its range to 3.5 points, and closes with a gain of, I think I went over that like 3 times already. Anyway. On the 29th, the open is lower and the price recedes to 140, closing near the low. That low close, he looks at that a lot. We now observe that the average has spent 4 days moving sideways. 1, 2, 3, 4. Making no further progress after steep rise from... What does he mean by no further progress? Meaning the closes. Are you making progress in the closes? No. All right. And there's been a steady decrease in volume, meaning here, right here, there. So you had your climax, you had your change of behavior, and now there's a problem. In view of our previous deductions, we interpret this to mean there's a lessening of demand at the top of the rise. So this right here, he's interpreting as lessening of demand at the top of the rise. At the top of the rise, so we'll just add that lessening of demand at the top of a rise. We also note that any lateral movement or reaction would definitely break the upward stride. Upward stride meaning if you draw a trend line, the stride is broken. So this is the trend line right here. This one or this one? It's one of them. Maybe this. I don't know. Anyway, so some stride is going to be broken. What it just means is it's just the trend line is going to crack. On the 27th, bulges over, narrows its range. Looks like bidding up to new high in order to catch shorts and selling on the way down. New high meaning also taking out this resistance area. Like if you see over here, there's your new high, takes it out and then goes right back down. We therefore put out some shorts protecting our commitments. On the 29th, the opening is lower and the price recedes from this to that, closing near the low. Now observe the average has spent 4 days moving sideways, making no further progress. Falling 5 million share day, falling volume, lack of demand. We also note that any further lateral movement breaks the stride. Hence, we are ready to sell more stock. On the 30, the average declines nearly 3 points. The market's still in the 137, 143 zone, but now definitely dropped out of the sharp angle in which it rose from 19 to 27, showing exhaustion of buying power. Low volume on the low volume on the 2-day dip to the bottom of the range, however, suggests we may expect an effort to rally back up. So what is he talking about? He's talking about this dip right here. When it tries to go down, this volume is low. So I'd look for another attempt at the high. So, however, suggests we make another attempt. The way the market behaves on the expected rally will probably help confirm or it may contradict our position. So, this is an interesting way of how he's judging, all right? He says, basically you have a climax here, some shortening of thrust here, stride is broken there, there's lack of demand as volume tapers off. All right, now we have this kind of pullback. You know, it goes down here, it goes up here. Okay, what is this? Let's see if it's going to go. It goes down, this is bullish. This right here is bullish. Why? Because attempts to go down has low volume. Now that it has low volume, he's looking, he still hasn't confirmed anything. He's just saying that it's low volume, it's not ready to go down. The rally now is going to tell you more, because the rally is going to go at the resistance level. July 1st, there's a wider spread in price and nearly 2 points higher close, but volume shrinks to 1.7. What is this? July 1st? You know what he's talking about. He's talking about this. Okay, so I read it wrong. On July 2nd, the market narrows to a 3-point range for the average, and the close is on reduced volume, increased dullness. All right, lower close, increased dullness, lower close, and less volume indicate less power on the bull side. On the 3rd, there's another attempt to rally, and the average reaches the old 143 line of the trading zone, closing about 3 points higher, but the volume is not measured up to the standard of the previous rally days. Just saying that when you compare this, compare the other rally days. He does that a lot, where he compares volume of rallies to volumes of reactions in the past. And nothing to be afraid of. We sell more on this rally, which is the bulge we're waiting for. July 6th, the 2-point range for the average closes nearly 2 points below the with volume of 1 million shares. We read this as an indication that the rally could not be sustained. It's talking about right. Let's see. This is 7th. What about the 5th? It's a little bit difficult to read. Is that 3rd, 4th, 5th, 6th? It must be the 6th. It's either the 5th or the 6th. Okay. That bar is very bearish. That bar right there is a big problem for the bulls. In fact, I was looking at the SPY and I saw if you do this, you'll find the same thing. Take a look right before the rallies. Bull rallies or whatever. Just look at all the bull rallies. Just identify, okay, this is a rally, this is a rally, this is the rally, this is the rally. Take a look right before the bull rally, maybe 1 or 2 bars. You will see, in general, small range and small volume. Meaning this is like the concept of dullness. Many times it's this dullness that precedes the next rally. Just a tip. Here the liquidation is being resumed. The volume indicates this as it breaks right here. So just write that liquidation is being resumed. So once this break happens, it's just a breakdown, that's all it is. What does he assume? He assumes that it's going to go for the prior support. All right, so it's really important to know what the support levels are. So when one area breaks, you have some expectation in your mind about what to do and what are the possible scenarios. And he does the same thing over here. We assume that the next test of the market will be around the levels at which support was rendered on June 19th. So this level is the former support. What does this mean? All this means is after this breakdown, like what are you thinking? You're thinking that after that breakdown, what should happen? What should happen is the former support level be tested. Now this happens, we see this all the time in all these videos on YouTube, but this man is doing this in 1930. He's looking at the former support levels and looking for those levels to be tested. This breakdown is expected to test that support level, that end of that rally support end of the pullback support level from where the rally once started. And so what are the possibilities? Well, if CM is willing to take them back near or above the previous lows, it will be an indication that of continuation of the bull market. Otherwise, it's a problem. So we're looking for whether the support holds or not. If there's no such condition, we conclude that the bear market has been resumed and the June recovery was only an interruption of the main trend. I believe this is nothing more than counter trend on a monthly chart or something. So we're just looking for the resumption of the downward movement. So let's kind of sum up all this shit, all right? So you have this rally bar. It goes, it goes, it goes. It climaxes here. There's a change of behavior right here. There's a shortening thrust from high to high to high to high. And then eventually you have this reversal, right? And when you have this reversal, it comes after a lessening of demand. What is the lessening of demand? He explains it with a combination of shortening of the thrust as well as a decrease of volume. So once that happens, you have the market going lower. It attempts to rally, but the volume isn't that great. It pulls back. In my book, this is actually getting bullish right here, getting ready to test the market, but I don't think he thinks that. It attempts to rally, and what happens right here? It reverses. It's a red bar. That attempt to rally is a one-bar wonder. You have a reversal. That reversal is very low volume. That low volume is terrible. Small range, low volume equals dullness. A lot of times it equals a hinge or preparation for a move, a significant move. And in this case, that significant move was to the downside. Liquidation resumed. And since it's a break of this low right here, what are you expecting? You're expecting a test of the former support area. This concept here is extremely important. The average is now on the hinge and on the springboard for an important slump. So this is what Wyckoff was really big on. He's not big on springs. That came later, but he's very big on springboards. He mentions them many times, and what we want to do is kind of connect the logic. Meaning, what is the logic for a springboard? How do you identify it? How do you trade it? This is what matters. So what we want to do is see what leads to the conclusion that the market is on the springboard. All right? So that's really going to be the lesson for today, is to take a look at all this stuff and come to the conclusion that the market is on the springboard, starting with July 1st, all the way down to this section right here, which is July 6th. So from the 1st to the 6th is what we want to see. All right. So July 1st, there's a wide spread in price, nearly 2 points higher close, but the volume shrinks. Here is July 1st. This is a green bar. It has a wider spread. It makes a higher high, but the volume shrinks. Why is that bad? Everything was okay until the volume shrank. That shrinkage in volume turned the picture, because we are always weighing volume with price. So just think in your mind, what would make it bullish? Obviously, if the close is high, if the range is good, and the volume is higher, right? So what is the deviation from that picture? Well, the close is high, it's a green bar, you have a higher high. In some cases, the close would be bigger than the high of the prior day. But the one thing that fucks up everything is the volume is lower. And not only is it lower, but it's lower than 1, 2, 3, 4, 5, 6, 7. It's the lowest bar in multiple bars. That's the problem. That's how it's unconfirmed and actually bearish, because it shrinks. But at least you could say it's unconfirmed reversal because the volume did not come in. On this, all right, on the second, what the fuck happened on the second? Yeah, on the second, the market narrows to a 3-point range for the average, and close is 1.5 points lower on reduced volume. Here, this I don't understand, because over here he says on the second, yeah, you know, the market narrows to a 3-point range. All right, check. That's not good for the bulls. And the close is 1.5 points lower. It's a lower close. Again, check for the bears, right? So volume, the market, narrow range, low and close. The first one you could say, if you can't say it's bearish, you would say it's not bullish. The second, low end close, you have to say that that's bearish because it's a low end close, not a high end close. But then it says it's on reduced volume, and he interprets this as increased dullness, meaning a lack of activity or whatever you want to call it. Low close and less volume. Increased dullness, low close and less volume indicate less power on the bull side. But the way I see it, there's another way of looking at it, and that is you have this rally, potential rally bar, and after that it has no follow through. That's bearish. But what are the bullish factors? The bullish factor is when it tries to go down, there ain't no fucking volume. You see? So from that perspective, you could say, hey, look, they attempted to go down and test and found nothing. So this is where it gets very tricky, that your opinion might be different than what Wyckoff is teaching. And this all happens because of multiple bullish or bearish. The way I see this, you have this up thrust, it goes down, it's attempting now. When it attempts, the volume shrinks. And that's not good. If you don't say it's bearish, you say at least it's not bullish. Why? You expect more volume. Second, after this, you have a red bar. Again, bearish, like where's the juice? Right? Where's the whatever? But what would confuse me is like when it does that, I would expect another rally. And it does. It attempts to rally right here. Here, the volume increases. Now, what he doesn't mention, but in his logic it's there, he doesn't mention is watch that I'd be looking for, by the way. You see from this high to here, the volumes are decreasing. You see here to here to here to here. This volume on this bar is sudden. So in my mind, it's a minor climax. And it would be confirmed by the red bar after that. Not confirmed, but like strong. I can't really explain it. But that right there is sudden. He doesn't mention it anywhere here or whatever. But that is bigger than 1, 2, 3 prior bars. And it's on the top of this minor test, meaning it's testing that high. It increases in volume, and it's right after it, there's this problem child right over here, which means, because when you have this green bar with volume, you have to really look at the bar after it and try to make sense of this. So he doesn't mention it here, but his logic, this fits the picture. What he mentions, I forgot what he mentions, but he mentions something. All right. There's another attempt to rally, and the average reaches the old supply line at the upper edge of the trading zone, closing about 3 points higher, but the volume is not measured up to the standard of the previous rally days. I think it's sudden, but whatever. Nothing to be afraid of, sell it. On the July 6th, a 2-point rally of the average 2-point range, closing nearly 2 points down on a million shares. We read this indication that the rally of the first to the third could not be sustained, and that the tendency towards narrow swings, heaviness, and dullness is the result of the market becoming saturated with offers. All right. Right there, it's on the springboard. Oh, shit, what did I do? Yeah, messed something up. Anyway, point is, it's on the springboard, on that little bar. So we just put SPB. SPB. Oh, yeah, maybe I can do it now. I can't do it. All right. So what the So that point, it is that dullness sets up the springboard. All right, but it's actually a collective judgment across multiple bars. But right here, what we see is a climax on high volume, followed by a change of behavior, followed by some testing high, bid up to catch the shorts. So why did the market, after a change of behavior, continue higher? It did so to trap the shorts. That's why it went above this resistance area, because it wants people to buy in. But this climax was the indication that the market is nearing a turning point, followed with this change of behavior, which strengthens that belief. After that, you have this bar here. Don't really know what to make of that bar, but this bar, together with the prior bar, sets up the breakout failure on low volume. And together, all of this is a lack of demand. After that, you have your reversal from the resistance area. So it's not just any reversal, it's a reversal from the resistance area after the attempt to break out was on low volume. Right? This is very important. And after that, it has some follow through. After that, you had another attempt by the bulls right here, but this attempt is feeble because although price is there, volume isn't. Volume is not confirming the continuation of the rally. Here you have a pullback on low volume, and to me that means that from a bullish standpoint, it has low volume on a pullback, which means expect a rally. From a bearish standpoint, it means the prior day here has no follow through. That's the way I interpret it. After that, you have this volume come here, right here. And like what do you make of it? It is increasing. It is bigger than the last 3 bars, and it is testing that same area where people are trapped, right? That bar. Problem is its potential minor climax, although he doesn't mention it here. And what confirms that is the lower high, lower low, and the lower close, meaning the red bar. When it does that, the market is on a hinge, it's on a springboard. Why? Because it attempted to rally, it screwed up, it went here, and it's utter sign of dullness, heaviness, and problems. Right there, the market is on a springboard. And what happens after the springboard? You typically get some form of markup or markdown that may be in the form of a rally or whatever, or a brand new trend. And there you go. So I've covered a lot of concepts. Oh shit, I always mess up. And it's important to be able to like put the logic together because no indicator can do this. All right. All right, that's all, folks. Thanks.